All right, let's dive right in. We're going to crack open one of the most important documents in all of business, the profit and loss statement. You can think of it as telling a company's financial story. We're going to follow the money, right from the very first dollar that comes in all the way down to what's actually left in the bank at the end.
I mean, you've heard this phrase a million times, right? In meetings, on the news, people always say, just get to the bottom line. Well, what is the bottom line? In the next few minutes, you're not just going to understand what that means, you're going to see the whole journey of how a company gets there. So, what is a P&L statement, really? The best way to think about it is like a report card for a business. But here's the key. It's not for the whole life of the company. It's a snapshot, you know? It shows how the business performed over a very specific time, like a single quarter or a full year. And it answers the most important question of all. Did we actually make any money? Okay, so every financial story has to start somewhere. And for the P&L, that starting point is right at the very top. We're going to begin with the first dollar that ever comes through the door. And here it is, revenue. This is the top line. And it's called the top line for a really simple reason. It's literally the first line on the statement. This is all the money a company brings in from selling its stuff, all of it, before a single penny in costs is taken out. It's the big, gross, untouched pile of cash we start with. Okay, to make this super clear, let's use a really simple example. Let's pretend we have a small company, and they've had a pretty good quarter. They brought in exactly $1,000 in revenue. That's our starting number, that's our top line. But of course, that $1,000 isn't pure profit, right? You have to spend money to make money. So the very next thing we do is subtract the direct costs of making the product we sold. We're talking raw materials, the labor to assemble it, all that stuff gets bundled into one line item, cost of goods sold. You'll usually just hear it called COGS.
So let's go back to our company. They made that $1,000, but let's say it cost them $400 in materials and labor to produce everything they sold. So you take the revenue, subtract the COGS, and what's left over? $600. And that number has a name, gross profit. This is our first big milestone. And this number, gross profit, is absolutely crucial. Why? Because it answers the most basic question in business. Can you actually sell your product for more than it costs you to make it? If you have a healthy gross profit, it means your fundamental business model is sound. You're actually creating value. So far so good. Our little company can make and sell its product at a profit. But that's just the first part of the story, right? Now we have to factor in all the other costs of just running the business itself. This is where we subtract what are called operating expenses. Think of this as all the money it takes to, keep the lights on. We're talking about salaries and benefits for your employees, rent for the office, your utility bills, and of course, all the money you spend on marketing and sales to get customers in the door. Now, inside these operating expenses, there's one idea that can be a little tricky. It's called depreciation. Here's the deal. It's an expense, but no cash actually leaves your bank account. Let's say a company buys a giant, expensive machine. Instead of counting that whole cost in one go, accountants spread the cost out over several years, over the machine's useful life. It's what we call a non-cash expense.
And this is a really important idea to get your head around in accounting. Just because something is listed as an expense on paper, it doesn't mean cash literally just flew out the door. Depreciation lowers your official profit for the year, but the actual money for that machine, that might have been spent 5 years ago.
Okay, back to our example. We had $600 in gross profit. Now, let's say all those operating expenses, salaries, rent, marketing, everything, add up to $300. We subtract that, and we're left with $300. This number is our operating profit. You'll also hear it called EBIT, which stands for earnings before interest and taxes. It's a fantastic way to see how efficient the core business really is. And this brings up another term you've probably heard thrown around by financial folks, EBITDA. The difference is actually pretty simple. To get to EBITDA, you take the operating profit, the EBIT we just calculated, and you add back those non-cash charges like depreciation. So why would you do that? Well, it gives you a quick and dirty look at how much actual cash the business is generating by ignoring some of those accounting rules. Okay, we're so close. We've paid for making the product, we've paid for running the business. There's just one last section to get through before we arrive at the number everyone's been waiting for. We started with that $300 in operating profit, but there's one more bill to pay, and it's a big one, taxes. So after we subtract the company's income tax,
let's just say it's $100, we finally get there. The famous bottom line. In our example, it's $200 of net profit.
This is it. This is the bottom line. It's what's truly left over after every single expense, the cash ones, the non-cash ones, the taxes, everything has been paid. This is the ultimate scorecard for how profitable a company was during that period. And really, the bottom line can only tell one of two stories. If it's a profit, that's great. It means there's money left to reinvest in the company, to innovate, or to give back to the owners. But if it's a loss, well, that's a pretty clear sign that something's not right. Either the costs are way too high, or the business is just struggling to compete. So there you have it. We've made the full journey, from the top line all the way down to the bottom. But why does this matter? What's the point? Well, because now we can use these numbers to ask really smart questions and make much better decisions.
See, once you understand the P&L, you can do some really powerful stuff with it. You can calculate things like profit margins, which tell you how efficient the company is at making money. You can look at your actual spending and compare it to what you plan to spend. And, best of all, you can use this data to actually back up your financial decisions with hard facts.
Let's just quickly go back to our example one last time. We started with $1,000 in sales and we ended up with $200 in net profit. If you do the math, that's a net profit margin of 20%. And what that means is for every single dollar that came in the door, the company was able to hang on to 20 cents as pure profit. That's a really powerful number.
And that's the whole journey, from the top line to the bottom line. Now you know how to read the financial story that a P&L is telling you. You've got the map. So the only real question left is, what story is the P&L of your favorite company telling you?